Thank you, Ralph, for your presentation. Now, it is certainly interesting to see how COVID-19 has impacted financial reporting in Australia. And one of the big questions indeed is what would be the new normal? I mean, are we actually ready to face new normal? Now, ladies and gentlemen, I would like to kindly remind you again of our housekeeping rules. So please kindly observe the rules to ensure that the webinar can be delivered effectively. You may also submit your question in the chat box. I can see that there are a few questions already flagging in. So we thank you for that. So we expect you to submit your questions throughout the presentation. Now, I would like to next invite Simon to deliver his presentation. I think it is certainly an exciting time for Malaysia with the gradual opening of the economic sectors. Now, let us hear from him about some of the initiatives that MIA has introduced to respond to COVID-19. Simon?
Thank you, Aucky. Salam sejahtera to all friends in Indonesia and also fellow Malaysians if you are in the webinar. I'm delighted and privileged to be on the panelists with two distinguished panelists, Ralph and also Djohan from Indonesia. So really, yeah, thanks to Ralph for setting the stage and to make it easy for me to enter into my conversation with all of you. Certainly, it is an unprecedented time that we are facing, and it's challenging. We have situations where there is economic downturn, there is situation where there is liquidity issues leading to decline in consumer spending, impact on increasing in inventory levels. There is also impact on the reduction in production, and therefore there's an impact on workers, and then perhaps consideration of laying off of workers, and then as the cycle continues. So it's actually a vicious cycle. So situations where, actually there is a need for the government to actually step in to intervene to support the businesses. And therefore, Malaysia recently, with the reopening of the economy, we are still very, very cautious looking at the situation and trying to our level best to slowly phase in, but at the same time, maintaining very high hygiene standard of hygiene, and also social distancing, and all this becomes now the norm, right? So increasing use of technology to be able to do meetings online, like having this webinar, right? So that's a situation that's the new normal here in Malaysia. So probably I won't share that much concerning some of the facts in Malaysia. Probably you in ASEAN, you're familiar with the news of what's happening here. But probably I would like to build on what Ralph mentioned, because there will be some overlaps when I share concerning some of the considerations of financial reporting. But at the same time, I would like to also take a step back and look at from the bigger picture as to the entire financial reporting ecosystem. So perhaps maybe we go to the next slide. Yeah, okay. So perhaps the one of the byword recently is that instead of EBITDA, we look at EBITDAC. That means earnings before interest, tax, depreciation, amortization, and coronavirus. But bear in mind that IAS 1, you're not allowed to show an extraordinary items as a separate line in the face of the balance sheet, face of the income statement, and also on the notes to financial statements. But you can show significant items on the face of the main financial statements. So now back to taking a step back and looking at the broader financial reporting ecosystem. Firstly, I think if you're an accountant or an auditor, firstly, what's in your mind is probably the challenges is how you're going to be accounting for the impact of coronavirus, the COVID-19, what is the disclosures that you're going to be facing. But I think generally, if you ask CFOs, those who are in the forefront in their companies, the first thing that they think of, yeah, of course, at the back of mind, there will be financial reporting, there are implications there. But the first thing is that they need to survive, the business need to survive. So business continuity is actually the main first priority. And that situation where how finance, those in the finance function needs to rise to the occasion to actually support the organization, firstly, to weather the storm. That's first. That's the first thing to consider. Secondly, then of course, cash flow management, because when you are in depressed situations, then whether are you able to meet your financial obligations. So cash flow management becomes very crucial, and increasingly we see, based on my conversations with leaders in finance, and I myself, previously in my past life, I'm an auditor. Now I'm also from the other side, I'm also a preparer and I'm being audited. So I look at both sides, right? So from a cash flow management perspective, then there's a need to do forecast, to look at where are the points where, where there's need for support, and where are the areas that we need to rationalize so that we can manage and weather the storm. So the other matters that will be very pertinent in this trying time, would be also to engage very much with the operations, the people in operations, because, for example, in Malaysia, Astro, during the movement control order period, they actually had free streamings, free offerings for people, and then perhaps maybe through that they can convert some of to get new clients. So their business model would have changed. Operations would have changed. So the business model and operations changing would also have an impact on has a financial implication on the organization. So finance needs to go beyond the typical area, the ambit of finance function, to actually partner the business and identify what are the changes and also account for them accordingly. The other area that is also very crucial during this period is communication with the stakeholders, because the organization does not exist in by itself, and it needs to interact with all the various stakeholders. So in discussion with companies and with auditors, one of the areas would be how do you communicate with the board of directors, right? Because with all these situations, then in terms of communication and relating to accounting, how are you going to deal with for a situation where everything is rosy and positive, it's quite easy to do the accounting. But when it's challenging, trying times, not only would your profit has dropped, maybe revenue would have declined, significant challenges in operations, but then you will have issues with impairment. So you have a double decline in the bottom line. So that's the impact is very significant at such a time. So how do you actually communicate? So in dealing with your customers, for example, in dealing with suppliers, dealing with employees during this difficult time, there are situations where maybe some will need to, there's an impact to the rationalization of the employee cost, right? So there are a lot of factors that needs to be managed with the stakeholders during this period. Next, of course, now we come closer to the core area that we're talking about, which is accounting and auditing, is the reporting timeline. So, if you're in lockup, if you are in lockdown situation, and a situation where there's restricted movements, social distancing is no longer the norm as the past, even with the reopening of the economy, is not business as usual compared to the past, because even going to the client's location and all that, how do you communicate, contact with one another? These are all challenging, very challenging times, for businesses and also for auditors to do the audit. So then there's a need to consider whether the timelines could be met, within the typical timeline that was that corporates need to report. So with that, MIA has done a lot to address this. I'll show you in the next slide. But the other area would be on logistical issues, which would be restriction to locations. So we have in Malaysia, there is the movement control order actually passed the end of March. So there are some March year end. So how do you do inventory counts during that time, right? So not only is the issue with the auditors, but actually for the organization itself, physical access to locations, and ability to do inventory counts, all this becomes challenging in such a time. So something really unprecedented and needs to be planned and addressed, right? Because even with the from the management perspective, if it can be done, then what about from the auditor's perspective? Then they need to have access, they need to be able to gather sufficient audit evidence, to opine on the financial statements. Last but not least, then we come to the part of audit, accounting and also auditing. So if you look at it, it's an entire financial reporting ecosystem, and it's not something that is done in isolation with all the various stakeholders, the whole value chain, chain of financial reporting. Okay, next slide. Right. So MIA as the developer, being involved in developing and regulating the accountancy profession in Malaysia, having the mandate to do that for nation building. So we are the voice of the profession. So during this period, of course, the first thing that's been addressed is in terms of the deadlines, being able to meet the reporting deadlines. So we engage with the other regulators, the other government agencies, such as the Companies Commission of Malaysia, the Malaysian Stock Exchange, and also the Inland Revenue Board in terms of the reporting time frame and deadlines. So there were some rising from a lot of these conversations and also lobbies from other organizations. They actually have, allowed for some changes in deadlines and extension of deadlines. The other area that during this period, because it's very critical for not only the large organizations affected, but especially the SMEs, the small and medium, they really struggled when the economy came to a standstill. So as a result, there is a need for some financial support. So some of these organizations, companies, they are not experienced in terms of how do they actually get access to the government aids, able to get, apply and get access to the incentives and the stimulus packages. So we actually asked that the accountancy services be allowed as an essential service, something which is similar to what in the US and something done in Canada too, right? So we actually wrote to them, and in fact, we actually obtained to allow certain services to be allowed for during this period, but then the reopening of the economy was announced. So that became superseded that offer to actually to be able to operate during this period. The other area that we will engage was also looking at economic stimulus package. It's an area that to see how we can stimulate back the economy. What are the areas that the government needs to focus on in terms of supporting the SMEs, especially those most affected by the COVID-19 outbreak. And also looking at post movement control order measures that the government needs to consider in order to stimulate the economy and restore the economy. Last but not least, there's also an area which is on the financing schemes to support the affected entities, where we also engage with financial institutions to see how they can actually make some of these funds available to affected parties. So we have been also doing a lot of communication on that. Next slide. So in terms of the what the Institute has done, we have been doing a lot of communications with members, continuous communication and support for members through issuing a lot of circulars. So we actually have a site where there are a lot of all the circulars are all arranged there, and we also have FAQs for COVID-19 FAQs on auditing. We covered some of the areas covered. Later on, I will touch on that. Maybe probably the core areas is one on concerning the general audit considerations relating to auditing. Secondly is an area that is being addressed, concerned by many auditors is on group audits, because then locations are restricted and they cannot fly over to certain places or to travel to certain areas. So that there's some concern there. And issues with going concern is another area. Subsequent events, how do you treat them? And then also on the auditor's report. So these are the broad areas that was covered in FAQs, and I'll touch on that later a little bit. And we also came up with some articles. So we We also engage with CFO's finance function and how they actually can contribute during this period. On harnessing technology, it's actually quite timely. So if you ask people what caused technology transformation, IT transformation in your organization, and you give them an ABCD, EOB, customers, C, employees, and D, coronavirus. Probably they put D, because it's really a situation that it is really, this pandemic has been an accelerator for the adoption of technology. So some of the things I'll talk about in harnessing technology. One is on how that can help with the business continuity, being able to do things online and without having physical presence, increase in communication, by using technology, communication with stakeholders, how they can still reach out to one another during this time. The other one is the pivot towards technology, how they should embrace technology and use technology to their advantage. Last but not least is also to the introduction of some technology tools. It could be auditing software, it could be accounting software, it could be data analytics. Some of these tools, some which are low-hanging fruits that can be easily obtained and where benefits could be reaped easily, and some that needs a little bit of investment. So what are the stages of progress in terms of how organizations can harness technology during this period? Last but not least, of course, there is financial reporting implications. We also issued a circular that was released by the Malaysian Accounting Standards Board. They issued the standards, the accounting standards in Malaysia, which is completely aligned and converged with IFRS. And for us, we issue the auditing standards. MAI issues the auditing standards. So MASB came out with MFRS 9 financial instruments expected credit loss considerations. And because in Malaysia, the government gave moratorium periods, extension of holidays, a period where you don't need to actually pay the loans. So this automatically agreed by the banks, and it's driven by the central bank and with the collaboration of all the banks. So with that, then the question is then, is there a significant increase in credit risk? So that paper also addresses that it may be a situation where, because it is regulatory in nature and it's driven, it doesn't mean that overall the lifetime credit risk would have increased for all parties, but because, as we can see from the coronavirus, certain industries are actually significantly affected. Hospitality industries, hotels, you look at the retail industry, all these entertainment industries significantly impacted. So it cannot be also said that everything still is the same, because then you would have certain industries, certain organizations where it would be really a significant increase in credit risk. So there are some considerations there. Okay, we go to the next slide. Right, okay, so these are some key takeaways that we discussed with leaders of the finance function, saying that they should come out, they should take the lead during this period and be business partners and weather the storm in the organization. Scenario setting out the various scenarios, looking at the credit facilities that are needed, what are the stress factors, different scenarios, different how do they address them, and basically drive the decisions that is needed in the organization. Prioritize business continuity, cash being king. So the situations where we looked at during the engagement with these leaders, some of the things that resonate with them was the need to reassess balance sheet management versus P&L management. So it's not just merely achieving a target, a bottom line number, but also at the same time rationalizing on cash. So it could be a situation where inventories need to be sold at a lesser price so that there would be cash flows. But all this would also give rise to considerations whether there is a need to write down inventories net realizable value. So when the finance function are involved in all these things, then they are more informed about the economic substance of transactions and events that are happening in organization, and they are better able to account for them actually. So actually being involved in all these areas actually helps with the accounting. So there is also the need to focus on stakeholder engagement, dealing with directors, managing the expectation, informing them about the situation of the organization, dealing with customers, dealing with suppliers. Then, of course, internally, there is also employees, right? How do they actually work with them? Recalibrate work culture, situations where we work from home, how that actually works. We're looking at business models, because then now there's a situation that you need to innovate and be able to look at, carve other areas where it could be niche areas where the organizations need to focus on. For example, if you are in training, for example, then obviously then you can't be having, physical courses, then you need to rethink and consider whether, you need to have increase in e-learns and webinars, for example, if you're in the education services industry. So the other area is on managing the impact of financial reporting, which is at the heart of what we are discussing today. And last but not least is to plan beyond the MCO, which is also very crucial, because you look at business continuity and the next phase. Okay, next. Yeah, thanks. Initiatives on financial literacy of SMEs is also something that is close to our heart, because when we look at the whole ecosystem in Malaysia, it's not only the large organizations, the listed companies, right, but also the SMEs needs to be taken care of, because they are the backbone of the economy and they contribute significantly to the GDP. So we also looked at how Business Excellence Guide for SMEs, which is about to be released, and we focus a lot on how SMEs needs to be supported in business functions, bookkeeping, financial reporting, business advisory services, right? Especially in these difficult times in cash flow management and all that, right? So it becomes very crucial. So we also create awareness about financial literacy for SMEs to also help them during this difficult time. Next slide. Okay, so now we come to the area of financial reporting considerations. So Ralph would have covered quite a lot of areas on accounting, but he did have one slide on auditing. So I'm going to balance it, because whatever is being done in accounting, you need to bear in mind, at the end of the day, the auditors will be coming, and they are also be looking at the what they have reported, what numbers if you have, what are the disclosures, and they will be probably challenging you. And just also to bear in mind that auditing standards such as ISA 540 requires the auditors to exercise more increased professional skepticism, and the methodology in terms of how they assess estimates becomes more robust, and they also look at corroborative evidence and also contradictory evidence. So a lot of considerations there in terms of how they are going to be auditing all these areas which are very judgmental in this difficult time, right? So the first area from an entity and group reporting perspective, then we touch about on logistical issues, about access to locations, inventory counts, could also in the past never really thought about that is an issue. Now it actually could be an area that is of concern, and not just from an audit perspective, but from the entity perspective that needs to be addressed. Debt covenants, because now liquidity could be an issue. Is there default? If there is, then you have to also consider the accounting considerations, whether if there's a classification area, reclassification needed from non-current to current. And there is also a consideration that what are the clauses, what are the terms of the debt covenants? Because in unusual or certain cases, the debt covenant could be a situation where there is default, then the lender has got significant powers that could even actually encroach on the power of the parent. So it could be a situation that they actually now have power over the entity, and then you need to also assess whether there is rights to variable returns, and also the ability to exercise that right. So if that's the case, then actually control is taken over by the lender. So there is actually a deconsolidation situation. So so that is also another implication to think about. Closing process, where the employees are working at different places, how could that be coordinated? Materiality, right? Because IFRS, the accounting standards are meant to apply to material items, right? Then group level, then you have group reporting. So if you have an organization, you have an entity in China, last year, you have to consider whether is there an impact, right? If you have subsidiaries in other countries, right? So there is also group reporting consideration. So the flip side of it, the other side of it is on auditing. So when this situation happened, we at the institute, we converged and discussed with auditors and see what are the key areas, key concerns, frequently asked questions, and we have also received technical queries on certain areas. And then when we looked at it, then we realized that, wow, this is an area where that it's like all auditing standards are affected. I mean, that's impacted. If you look at any standard, you can see that how it could be linked to this issue. So it's very pervasive. And so, when we look at our FAQs, we were questioned why we need to list up all the auditing standards, but we felt that we need to, because then it shows the breadth and the scope of the areas that needs to be considered by auditors. So one of the areas is identifying and assessing the risk of material misstatements. So this is definitely an area, whether it's a non-adjusting event or adjusting event, it is an area that you need to consider. And so that actually some adjustment in audit planning, materiality in planning and performing an audit, whether there's a need to change, assess, reassess materiality. Then of course that with all the assessment, then there's need to be a response to this assessment. Consideration about audit evidence, ISA 510 in particular on inventory counts. Practically, how do you do inventory counts during this time where there are significant restrictions? So there are some, practical considerations to be thought about, such as, for example, in terms of having involvement of internal auditors, for example, having direct direct assistance by internal auditors in terms of helping with inventory counts, maybe relying more on cycle counts, right? And then using technology, for example, increasingly there's consideration to use technology, but of course with technology you have to consider certain other controls and limitations of that. For example, if you use a drone, then how do you assess, select samples for those items that are sealed, for example. So completeness and all these considerations which be taken into account in terms of auditing. Of course, then there is also technology of using video to actually look at certain inventory items. So there's all these considerations comes in in such an environment. So you have ISA 600 special considerations for group audits. Then traditionally in the past, it could be situations where auditors travel to actually review working papers. So these situations that now is no longer conducive for that. Then there is a need for using technology, for example, as to how you can access working papers. All these arrangements needs to be done. So the other area, of course, that Rolf touched on is the impairment, write-downs, and provisions. So in this area, looking at the appropriateness of carrying amounts of non-current assets, the usual areas, property, plant and equipment, intangible assets, goodwill. And in situations where now with the stock market being depressed, there's a situation where the market capitalization may be lower than the net assets. So if that's the case, then it's actually an impairment indicator. And there, even for annual impairment tests, you may need to bring forward to it, because then there is already an indicator there. So there is a consideration of how you're going to be doing the impairment assessment for property, plant and equipment, intangible assets, goodwill. And Ralph talks about this discounting. That's an interesting area, and also could be potentially complex, because now there could be government easing off the lending rate, and then there is also perhaps an increase in risk. So it could be, it depends. There may be no change to that, but then you need to adjust the cash flows of, either you adjust the cash flows or you adjust the rates, right? But not both. So you adjust the cash flows, which I think a lot of proponents prefer to adjust the cash flows, because then it's more specific, and you adjust it for the impact of COVID-19, and thereafter use a discount using the discount rate. The other thought is on deferred tax assets. So it should match, because then if you look at if you're going to have impairment, then is it likely that your cash flows are affected, then your taxable income, right? Sufficiency of a taxable income would be in question. And especially if you are doing having consecutive losses, then there is a need to disclose if you still have deferred tax assets. Why would it still be considered recoverable? So deferred tax assets will be an area that needs to be focused on too. Inventories, in particular, Ralph also covered that. The area that where maybe organizations are now in need of cash, they may be selling it at a loss even. So as a result, there could be an issue with net realizable value, something that existed as at the period end. So it still needs to be assessed whether it's something that exists as a period end, and also looking at obsolescence. This is another consideration. The other area is during this period there is perhaps significant slowdown in terms of production. So as a result, there could be certain overheads. It's overheads which are in the past being absorbed equally in a product under a normal capacity. And now if you absorb it, then it becomes overly significant. Then inventories will be overstated if that's done. So the standard requires that you do not overstate the inventory by but only recognize the absorption based on the normal capacity. So that's also another area of consideration. So in net realizable value, there are two aspects, which is on the closing inventories and also the raw materials. For closing inventories, I think then you can look at the selling price, that's the cost to sell, right? But raw materials, you only write it down if you're going to be selling it at a loss when it's converted to finished goods. So the standard says that you only do that if it's selling at a loss when it's converted to finished goods. So we have to assess that. And if indeed it's sold at a loss, then the amount to consider for inventory, for raw materials write down would be, the standard says looking at replacement cost could be one area to consider. Then of course, financial instruments, you have receivables, and you have looking at the loans and receivables, and then you have also trade receivables to consider for impairment. Ralph talks about the expected credit loss, right? And then we talked also here, and the area of provisions is also another area. I know, Aucky, I'm running out of time, okay? But okay, I'll touch on provisions. Okay, provisions to be considered, and the rule is that you need to consider impairment first, and then thereafter only provisions. So provisions, there were certain areas because of the change in environment and the change in demand, there could be certain contracts now could become onerous, and you need to provide for that upfront. The general principle is that you won't provide for future losses, but in this case, because the contract now becomes onerous and you're making a loss, you need to provide upfront. The other area will be restructuring, where situations where organizations will need to change and retrench certain people. You only do the provision when there is a set plan that has already been set up, and also there's a valid expectation created by those who will be affected by the plan. So these are the two areas that needs to be, two criteria that needs to be met in order for a provision to be made. So all this, the auditors will be asking the preparers, because then, looking at the judgmental areas, especially under ISA 540, which is going to be in place this year, you need to look at the methods, the significant assumptions, the source of data, and the related disclosures. So it's very more robust and more structured. So the auditors will be in a position to challenge you as compared to maybe in the previous years. So it's more, the methodology is clearer under ISA 540. So if you're a preparer, get ready for that. Okay, and auditor, you need to comply with that. Okay, then next. Okay, I need to rush a little bit. Okay, and ongoing concern, this is an area that, okay, perhaps then I share that I also want to look at actual live example. I managed to find a recent example in Centurious Metals Limited. This is a company in Australia. They came up with one of the earliest companies that had some disclosure on COVID-19 impact. So they actually disclosed on how their going concern considerations. They have a material uncertainty relating to going concern. So that was disclosed in this report and also disclosed in the books of the financial statements. So, and they also did mention about the impact of COVID-19, how that also affects the going concern considerations. So that's an area, one company that you can think can have a look at is Centaurus, CNTAURUS Metals Limited, right? So basically, the point here is that for going concern in MFRS 1, IS 1, right? There is a requirement for organizations to consider and in making an assessment of whether there is material uncertainties related to going concern, and the auditors needs to assess that. And there is a rule under IS 10 that for subsequent events, situations where you are already aware that the company is going to be closing down, for example, winding up, or there is way that the company could continue as a going concern, right? So that it's in itself becomes adjusting. So it is an exception to the rule. It is you need to adjust. You need to change the financial reporting into to report based on non-going concern basis. So that's one other thing to think about. Next slide. Okay, we talked about events occurring after the period. So there's the 31st December year ends. It's quite clear cut. Most of the organizations would, the impact of coronavirus in most countries are actually after that. So it's, I think there's general consensus that it's not adjusting event. 31st January is arguable, but I know that there are a lot of thoughts that it is still not an adjusting event for 31st January. But bear in mind that during that period, there was already a declaration by World Health Organization that it was there is actually a public health emergency that was towards the end, I think 30th of January. But it was on the 11th of March that the World Health Organization declared as a pandemic, right? So then the question is, what about February year end? What about then March year end? I think is very clear. February year end, something to be discussed, arguable, right? So this is something we can talk about later. And then in terms of subsequent events, I talked about that. I think the key area to look at is you will expect disclosures for December year ends, and if the financial statements are not yet signed and will be signed during this period. And the question is the two key areas that needs to be disclosed. If it's material to the users of financial statements, there is the need to disclose the nature of the event that's qualitative, and then there is also an estimate of its financial impact. And if it cannot be estimated, then you need to have a specific statement to state so that it cannot be made. Next slide. Other financial reporting considerations, you have revenue from contracts with customers, and particularly variable considerations need to be thought about, because then your situations where your concession rates, your product returns change now. Employee benefits, I'm going to go faster a little. Employee benefits, you have termination benefits where you may have situations where you have whether you have created a valid expectation, by employees that they will be affected by it, right? And how do you account for it? That's one area, employee benefits, but there are a lot of considerations there. Leases, I think Ralph touched on that, on whether is there a modification of a lease, which requires a reassessment, a remeasurement of the lease. But if it's not a lease modification, then the adjustment will be onto the income statement. Government grant, during this period, you may have, like, for example, tax holidays or deferment of tax payment. That is scope grant standard, IAS 20, and that's actually under IAS 12 on the income tax standard. But the rest of it, it's under government grant. So you have to consider when the timing of recognition, if indeed the organization receives a grant. And then last but not least, of course, is the disclosure in the financial statements that you need to consider whether there are any significant areas of estimation uncertainty, critical judgment in applying accounting policies. This will be very robust because I would expect a lot of disclosures coming from there, and then especially the extent of disclosures regarding estimation uncertainty. The disclosure of liquidity risks will be something that we would expect to see because there could be a heightened increase there. Of course, also to consider when you have interim reporting, you have a first quarter, if you're a December year end, you have quarterly reporting in March. You need to consider also whether there is any explanation of events, transactions that are significant to the understanding of the financial statement. So that's an area that to take care of. Lastly, last but not least, the last slide, it's on the communication, okay? This is very important. So there is a need to communicate, engage those charged with governance and the board of directors early about the financial impact and how that's going to be done, any significant judgments and things that those charged with governance needs to be involved in, needs to approve and all that. So a lot of communication is needed, communication with other stakeholders. For auditors, you have ISA 260, communication with those charged with governance, where you have a plan, a change in scope and timing of the audit and any significant risks identified, and also significant findings during the audit. So that will be and another robust area is the ISA 700 series, where you have the audit report, you have the audit, whether it's going to key audit matter, and another thought is that whether would there be an emphasis on matter paragraph that will be relevant for the COVID-19. So all these lot of considerations and needs to be communicated early. Right. I think I'll stop here because we still have a Q&A and Djohan's turn. Sorry for taking up the time, but hopefully you find this useful.